Well, it's that time again. It's Federal Reserve meeting week. They're going to come out in 1 day and 22 hours and tell us if they're raising rates or not. So in this video, what I'm going to explain to you guys is why they're not going to raise rates and the reasons why behind it. So my name is Dan Free. I do a report every day to inform you guys the economics behind housing. And then today we're going to talk about interest rates and what the Federal Reserve is projected to do at this meeting and then future meetings. But what I want to start this out with is one big catalyst out there that a lot of people are losing sight on. And if you have this debt, you haven't lost sight on it, but you're probably going to have to start tightening up your belt. And what is that? Well, it's student loan payments. Well, I never thought in my wildest dreams student loan payments equated out to this number, and I'm going to get to that in a second. But you got to remember, student loans have not been in repayment mode for almost 3 years now. So that money that was being used for student loan debt was being used for car payments, housing payments, buying stuff. Exactly what the Federal Reserve doesn't want us to do. So the first thing I want to go over with you guys is how much student loan debt is kicking in now. That means how much money is not going to be spent on goods and services. So what I want to look at is what is the average student loan debt? And then let's equate out to how much of this does it come to on a monthly basis. And in my research, basically, I was flabbergasted. Let me share it with you. So the first thing I wanted to figure out is how much is the average student loan debt? So to find that out, I did the Google search, found this article. As of May of 2023, the average student loan payment was $503 a month. Okay, so that's a car payment or a little bit more than a car payment in most cases. Well, how many people actually have student loan debt? Now, this is the area that kind of threw me for a loop. 43.5 million have student loan debt. The average debt payment is $503. Actually, I had to go to ChatGPT to figure this out because my calculator wouldn't do it. If you have 43.5 million people paying $503 a month, that comes to $21 billion a month. Okay, so think about this, folks. $21 billion a month that used to be used for goods, services, and maybe savings accounts are now being taken out and just used for student loan debt. So that is going to take a huge chunk out of our inflation numbers because people just aren't going to have the money to spend on goods and leisures and everything else like that. Now, another piece of this puzzle that I want to talk to you guys about is the CPI. The CPI is an inflation number that the Federal Reserve monitors. Okay, here's a breakdown of it. All right, so the biggest piece of this puzzle, you don't see student loan debt in there, but you now see how much money is going to be spent monthly on student loan debt that's going to have to be taken away from one of these equations over here. Well, shelter is a hard one to take away with, but I want to focus in on shelter because it's the biggest component of our inflation numbers. So when we break this down, the good news here is also CNBC reported a news article just recently. Apartment rents are on the verge of decline due to massive supplies. And you can see that. That article was just not within a month ago. Okay, so what's happening with shelter prices? Again, the biggest component of this factor right here is this number is going down, and it's almost 0%. But let's really analyze this number. Okay, I'm just going to take some numbers out from this where we were at the peak. So just in March of this year, you can see it right through here. March of this year, the component price that we're using on here is, let's go through it and let's go to March. March is where we peaked. The shelter price right here was 8.18. Okay, that's the factor. So just work with me on this one. Shelter component 8.18. If I take my head out of the equation, where are we right now? Well, that shelter figure right now is at 7.25. Okay, so what I did is I went back to my ChatGPT and I said, well, if shelter went from 8.18 to now it's at 7.25, how much of a reduction is that? It's 11% reduction. Okay, so that's why I'm saying with the combination of student loan debt now kicking back in, we have the shelter, the biggest piece of the component of CPI, which is the consumer inflation numbers that the Federal Reserve watches. It's down 11%. There's no need for the Federal Reserve to really do anything other than just sit back and let a lot of this kind of transpire. Student loan debt enough just on its own is going to really contract our economy, okay? But one other piece of the puzzle that really is the kind of, I'll say the wild card here is right here. How much stimulus money is still not spent? Well, as of January 31st, 2023, there was $90.5 billion in funds still available with no expiration. So the government, state and local governments can use this any way they want. Like in Illinois, they're redoing our roads, our bridges, a ton of things. So that's why I'm saying this is we got $90 billion still to be used at state and local levels. That's why I'm truly not concerned about the jobs numbers and wage growth, because this money is being spent locally, but it's going to go away. So yes, it'll be a catalyst for us right now. And if it wasn't for this, we'd be in a recession for sure. So this is basically the silver lining behind our economy right now. But when you factor in student loan debt is going to pull out as much money as it is in our economy, and shelter prices coming down is a positive. Between those two things, there's no reason for the Federal Reserve to basically do anything. So let me explain a little bit where the Federal Reserve is right now on rates and what the explanation is on some of these charts. So the thing that we monitor on a daily basis is the FedWatch tool at the Chicago Mercantile Exchange. Basically, it's telling us what the likelihood is the Federal Reserve is going to change rates at the coming meetings. Well, it breaks down meeting by meeting by meeting, but right now it's telling us there's a 99% probability the Federal Reserve is not going to do anything. The reason being is the federal funds rate is right here. It's between 5.25 and 5.5 right now. Okay, so let's look at the probabilities of what they're going to do at the next coming meetings. Well, for that, we pulled up the probabilities tab, and where I'm at right now is actually go in the CME group. And well, you know what? I'll put the link down below so you guys can access this yourself. So this is basically telling us at the next meeting on 9/20, there's a 99% probability that they're not going to do anything. Okay, November, well, they're going to stay right here, the 5.25 to 5.5 rates, and they're going to stay there. This is what these charts are telling us. They're going to stay here all the way till 2024, and then they're going to start reducing rates. Okay, there's another piece of this puzzle that we like to look at, and it's called the dot plot. Okay, let me show you what the dot plot is, and let me tell you what it does. Basically, what it does is every time the Federal Reserve meets, all the members put a dot on where they expect or they personally want the federal funds rate. Well, at this next meeting, they're going to revise this whole thing. But as of today, this is where the dot plot is. Right now, you can see back in 2023, they're expected, the most dots are right here, and that range is 5.5 to 5.75. This is why people are telling you there is one more rate increase in the cards, because to get to 5.5 to 5.75, well, we'd have to go up of 0.25 because we're at 5.25 to 5.5 now. But what I want to show you guys is right through here. The Federal Reserve is saying that they're going to keep rates higher for longer. So that means they're going to have to update this dot plot. And at this coming meeting, they're going to do just that. So after they do this, not only are we going to look at the probabilities of their raising rates, we're going to look at the probabilities of where they expect the federal funds rate to be in 2024, 2025, and for years to come. So that's my report for today. So in conclusion, I'm saying the Federal Reserve should be done and should be done for good, because now that student loan debt is kicked back in and it's increasing our basically people's expenses by $21 billion a month, they're not going to have the money to spend on leisure, entertainment, new cars, and everything else. And then the good news or silver lining behind a lot of this too is housing numbers are starting to come down, the shelter costs of things. Between those two components, the Federal Reserve should have all their work done for them, and they should take their foot completely off the interest rate raising gas pedal. So that's my report for today. And this is basically what I do on a daily basis to keep you guys informed of the economics behind real estate. And if you like this video, please don't forget to give me a thumbs up. And if you like all my videos as well as my channel, please don't forget to subscribe down below. Join us on every video that we do. God bless, guys. Thanks so much for watching, and I'll see you tomorrow. Bye-bye.